Tesla, DeepSeek, Nvidia, and the Fed. There's some crazy stuff happening in the market right now. Tesla just had one of the craziest earnings calls that I've ever heard. Elon said that 2026 and 2027 is going to be epic. The Federal Reserve just kept interest rates flat, and that is big for the stock market. Interest rates are like gravity on the market, so we're going to break all that down to see if stocks will go higher or lower based on what the Fed's going to do. And then it's DeepSeek versus everybody. DeepSeek just came out with a new large language model that is much cheaper and more efficient to run. So we're going to break down if this truly is bad for companies like Nvidia, and maybe it's good for companies like Tesla, Google, and Meta. So all that's going to be broken down in this video right here, so buckle up. So let me do a quick refresh here. So at the time of recording, my account is up $11,000 today, $954,000 total. This is my Charles Schwab trading account. There's a lot of new plays that I recently made. I trimmed a few things, I added a few things, so we're going to go through that at the end of the video. But let's break down what's going on with Nvidia first. All right, so we got a 5-day chart here of Nvidia. You can see right here, this is when the DeepSeek news came out, and the stock totally pummeled. It went from 142 all the way down to 117, tried to recover a little bit, but then it went back down, and today it's fizzling out. It's down like 2.5%, trying to make a little rebound right here. Here's the deal, and here's why a lot of people are actually really scared about what DeepSeek could mean for companies like Nvidia. So the whole premise of DeepSeek is that they're able to train their large language models for a fraction of the cost versus what OpenAI, which is ChatGPT, does, for example. So just think about it. If you're a company like Meta or Google and you want to make a large language model, but now there's this way that you could train your model for maybe 1/5 of the price, meaning 20% of the total price, now maybe you're only going to order 1/5 of the total chips from Nvidia that you planned on needing. And that could potentially send ripples through the market. So Nvidia might get less chip sales. That could be bad for AMD. That could be bad for Intel. That could be bad for companies like Supermicro, where Supermicro makes pretty much like the server racks where you put the chips into them to keep them cold and house them in a big warehouse. All that stuff could be bad for those companies. So the semiconductor index could be under pressure here soon. Now, I think that nobody on planet Earth knows definitively how this is going to pan out going into the future. I've been reading so many bullish arguments for this, so many bearish arguments for it. There's a thing called Jevons paradox, where essentially as things become more efficient, there is a bullish demand for the product because it's cheaper and more accessible. But then there's also going to be the argument that maybe you're just going to need less chips going forward. So yeah, maybe some people that didn't think they could get into the AI market, they now can because it could be cheaper to train their model. But now big companies like Meta and Google and Microsoft, maybe they're not going to buy as many. It's hard to say right now. And I was just talking about this in my course members only Discord. A lot of people were asking me about Nvidia. Do we make a play on Nvidia? Do we buy the dip on Nvidia? And it's like, it's hard to know at this point right now. Yes, it is a dip, but yes, this could be bad for Nvidia going forward. Nobody knows. Whoever says it's going to be good for Nvidia going forward and they bought the dip, they're going to then go look like a genius. But whoever sold out and then it goes up, they're going to look like an idiot. But then whoever sold and it goes down, they're going to look like a genius also. So it's hard to know right now. And what Warren Buffett says is you don't have to form an opinion on everything. If you're unsure, if it's not possible to be sure, you don't have to form an opinion and you don't have to make a play. Especially at a time when I feel like the market is a little bit expensive right now. And what I'm going to go into in just a minute, some of the things that the Federal Reserve just said, it could be bad for the stock market going forward. So we're going to break that down, and then we're also going to break down why I don't have a lot of leverage here in my $954,000 Charles Schwab account. I want to have buying power in the event that the market goes down. There's so many experts right now because the market's been pretty much going straight up the last couple years. But I promise you, if the market takes a dip, which eventually it will, I will be prepared and most people will not be prepared. I have buying power ready to go. I cannot be wiped out even if the market falls 50%. I will be fine. I will be buying the crap out of that dip. All right, so let's break down Tesla now. So ever since Trump got elected, which was right here around November 4th on this chart right here, Tesla went from 242 all the way to 401 right now. It's been absolutely pumping. So Elon just said something pretty crazy on the earnings call that just happened, how 2026 and 2027 is going to be epic for the stock market. So every time in course members Discord when a high profile company reports earnings, I will do an analysis on it kind of like this. So we're going to break this down just in brief so you guys have the basis of what I think about Tesla. So the last 4 quarters of Tesla, if you add up the earnings, they did $242 per share. If you do $405 per share divided by 242, that is showing that Tesla right now is trading at a 167 PE ratio. Even if they were to double their earnings per share, Tesla is still going to be trading at roughly an 80 PE. Are they really going to double their earnings per share next year or this year? I doubt it. So there is a chance that Tesla can do a correction lower off of this high right here, because I feel like the true intrinsic value of Tesla right now is somewhere in this 200 range right here, not in this 401 range right now. I think it's a little bit expensive. Now, things did change, and I'm going to go into that in just a second, which is what Elon said on the call that could make the valuation justified. So what happens with companies that are expected to grow a lot, the PE ratios typically go way up, and then as the companies start to boost their earnings per share, which this number right here will go up, they will kind of like grow into the valuation. If the stock price crashes down and earnings go up, that is good for the valuation. That makes things cheaper. But if the stock kind of just trades sideways for the next couple years and the earnings per share goes way up, that will be good for the valuation. That will make it more attractive for me to want to make another play. So right now I have about 700 shares of Tesla, and that's roughly around like 10 to 15% of my net worth at the time of recording this. So it is still a small percent of my portfolio, but going forward, it could be a huge part of my portfolio based on the things that I'm going to tell you here in just a second. So earnings per share, they grew 3% year over year, which is not good. Revenue 2% year over year, that's not good. But the stock went up 103% in the last year. So the stock pumped, but revenue didn't pump, earnings didn't pump. That is why the PE ratio went up quite a bit right here. This is all in anticipation of the Optimus robot and full self-driving going mainstream. So Elon just said in an earnings call that Tesla is planning to do autonomous paid self-driving in Texas this year in June. He plans to roll out other cities and states towards the end of the year, and he just talked about it as, we're just gonna do a little trial here to see how it goes, and then we're gonna slowly expand our footprint. So here's the big problem, and here's something that's very interesting that Tesla is gonna have to deal with. Roughly 40,000 people die per year in car crashes. If a robotaxi gets in a car crash and kills just one person, it's gonna make massive news headlines, nobody's gonna trust these cars, and eventually Tesla's going to be under pressure for their robotaxis. But any improvement of safety over a human driver, it's worth it to do the robotaxi. Elon was just talking about in the call, and it made me laugh. He was like, if anybody even steps out of a robotaxi and they scrape their shin when they get out, they're going to be like, oh my god, the robotaxi hurt somebody, it's going to be bad. Like, there's going to be a lot of crazy news headlines around this. A lot of people are going to be talking crap, but you got to keep your eyes on the prize and focus on safety overall. So 167 is a high PE, no doubt, but explosive growth is expected. And going down right here, this is what I was talking about earlier. Elon is hyping up 2026 and saying there's going to be ridiculous growth in 27 and 28. This ridiculous growth is expected to come from Optimus, the robot, and the robotaxi network expanding. Just think about it. There's so many hours in a day that your car is sitting stagnant, not doing anything. Maybe you're at work, maybe you're sleeping, where you could send your car to the robotaxi network and it can make money for you. So Tesla cars are pretty cheap to start, but now that your car is going to be able to have this use case where it could go out into the wild and make money for you, the value of these Tesla cars could go up exponentially. So nobody knows what Tesla is actually going to do with the prices of their cars, the prices of the FSD, if you pay monthly, if you pay a one-time charge, whatever it may be. So there could be a lot of revenue that comes to Tesla in the next couple years from the robotaxi network, ways that we're not even thinking about right now. On top of that, the Optimus robot is expected to have some deliveries at the end of 2026. So robotaxi is now pretty much here, and the Optimus robot is now on the horizon. We kind of have a view of when we could expect Optimus to start hitting the bottom line, which I expect sometime in 2027. So now is the time for Tesla to actually deliver. They have to show us that they could deliver robotaxi in a safe way, in a way that scales, in a way that people are going to trust it, and then down the road show us that the Optimus robot, every single human on earth is going to want one or need one, because the productivity that it could do is worth it. And then if you guys want, you could pause the video or go back and you could read through some of the notes that I took from the earnings call right here. But what am I personally doing with Tesla? So I own roughly 700 shares, like I said before, roughly 10% of my net worth. I will plan to add shares of Tesla on pullbacks. My cost basis on Tesla is $140 per share. So I bought it a while ago, but I've been holding on to it and I continue to plan to hold on to it. I sold puts on Tesla a while ago. I bought calls on Tesla a while ago, and I made a crap ton of money on it. You only want to make plays when you have a high margin of safety on stuff like that. Don't just go shoot option trades at the wall and hope for the best. You have to understand how to value a company, how to know if they have a moat, how to know if they have a competitive advantage going forward, and how to know if you're paying a good price. Price is what you pay. Value is what you get. So for now, I think that the stock is definitely a little bit high. That doesn't mean that this whole pump right here, we're gonna have to dip and give it back. But what could happen is Tesla could essentially just grow into its valuation. So maybe it's overvalued in this territory right here, but as the earnings line comes like this and it starts to catch up where the tip of my cursor is, eventually if Tesla stays flat, earnings will most likely catch up to the value of the stock right here. So maybe just expect the next few years of Tesla to be very volatile. So I do think that you're going to be able to get in at a discount at some point. Now, let's finish up on Jerome Powell, because this is the whale in the room. This could be very, very bad for the stock market. I talk about all the time how interest rates are like gravity on the stock market. All right, so let's head over to the CME Fed Watch tool. So this tool basically just projects what interest rates are expected to be at. Interest rates are like gravity on the stock market. You guys know that I've said this 20 times before. I beat it in your guys' heads, and I know I'm annoying about it, but it really matters so much. If bond yields go up, that puts pressure on stocks to go down, because the risk-free rate of a bond is now more enticing than the risky rate in the stock market, especially at a time that the stock market is a little bit overvalued. So basically what this is saying is for the December 10th meeting of this year, there's roughly a 10% chance we get no cut because it's the same range right here, 28% chance we cut 25 basis points, and a 32% chance that we cut by 50 basis points. So basically what that's saying is we're going to fall somewhere in this range right here based on current data. So we're just going to expect that we get roughly 2 interest rate cuts this year for a total of 50 basis points. And this does have a lot of implications for the stock market. So what's very interesting is Jerome Powell started cutting rates around this period right here, but the 10-year bond yield actually pumped. It went all the way up to 4.78% right there. Now we fell to 4.5%. So it's very interesting. The market was not believing that the Fed was going to continue to cut interest rates. So that's why bond yields went up. But now what the Fed just recently said at the press conference a couple days ago is that interest rates are expected to go down. We are materially more tight than what the neutral rate is. The neutral rate is essentially where do we expect interest rates to fall for the long term. Right now we're at 4.25 to 4.5%. He is basically saying this is still tight, and he gave confidence to the market that interest rates are probably going to trend down going into the future because inflation is expected to go down going into the future too. So you can see by that, we went from 4.78% and now the 10-year bond is falling in yield. As the 10-year bond falls in yield, that looks good for the stock market because there's less competition there. This is going to be less enticing as this yield falls right here. So heading back over to the newsletter, and by the way, if you want to get this newsletter for free every day that the market's open, click the link below, I'll send it to you. So basically the economy is in balance, policy is tight but not too tight, and the Fed is positioned to make progress on inflation and support the labor market at the same time. If inflation goes up, they'll keep rates higher for longer. If inflation goes down, they can lower rates. If the labor market starts to weaken, they'll lower rates to try to support it. So I expect rates to trend down, but slowly, and you know my line, interest rates are gravity on the stock market. As rates fall, stocks become more attractive, assuming that you keep everything else the same. If rates go down, stocks are more attractive because there's really no other game in town. Now, heading back over to my Charles Schwab account, let me do another refresh here to see how we're doing throughout the day. It went up a little bit more. So the market's trying to come back a little bit. So some of the things that I recently did in my Charles Schwab account is I did take some profits. I took profits on some puts that I sold on Tesla. I took profits on some of the stuff that I did on Nvidia, because the market going forward, I feel like it's a little bit lofty, like I said before, but the whole DeepSeek thing and all these efficiencies that go around training your AI models, nobody knows how this is really going to pan out. And guess what? I don't have to know right now. I don't have to make an opinion. You can see my 1-year return. I'm up 89%. Look at my 2-year return, 183%. Totally crushing the stock market. This is the power of learning how to do the stock market the right way, how to value companies, how to know if they have a moat going forward, durable competitive advantage, going through the financial statements. All this stuff you guys have to understand. If you don't understand it, you're just a speculator and you're probably going to get wiped out in the stock market. So all this stuff I teach in my course below. Hundreds of people have already went through my course and it's totally changing their life. And the best part about doing my course is you could then come into course members only Discord. I show you all my plays that I make in real time, all my market updates in real time. So if you're interested in doing that, click the link below to get into the sale price. If you don't want to do that, watch this video right here. It's my story of how I went from $0 to over $2 million of net worth in just a few years. I'll see you guys there.